Good afternoon. Happy Tuesday. And thank you for joining me for another office hours training. I'm Crystal L. Gunn, your financial strategist. Part of that job as a strategist is to make you think outside of the box, to help you heal and redefine your personal financial relationship, or help you develop a strong business base. Also to help you get your whole life insurance things in place. Right? Also help you to have some aha moments, some self-discovery moments, helping you see what no longer serves you so that you can release all of that madness in order to soar. All of that helps with the breakthroughs. That's where you start to shift. That's where the magic happens, be it in your personal finances or your overall business. And it's still October. I can't believe that we are so close to the holiday season and the end of the year, but it is still October. It is still Financial Planning Awareness Month. And so today I want to talk about understanding and reducing your debt to income ratio as we talk about your overall financial plan, right? So your debt to income ratio, your DTI, as it's known in the industry, right? So your debt to income ratio shows you how much of your income goes towards paying your debt. And it's a key measure for your financial health, especially when applying for loans or mortgages. So basically it's the percentage or the ratio of what you have coming in versus what you have going out. Right? And the lower your debt to income ratio, obviously it increases your chances of loan approval and improve your financial security, but it also just provides some peace of mind. Listen, debt is not like, it's definitely not biblical, but debt doesn't do you well, right? So let's look at some key points to consider. The first one is how to calculate your debt to income ratio. So you want to divide your total monthly debt payments by your gross monthly income. That's the calculation that the lender is going to use, right? And so it's how much of those debt payments, what percentage of the debt payments is your gross monthly income. So if your debt payments is $1,000 and your income is $4,000, your debt to income ratio would be 25%, right? So 1,000 divided by 4,000. Now, here's what's interesting. And even when I used to write mortgage loans, I always had my clients, we knew what their debt to income ratio was based off of pulling credit report and putting in income. We know what their debt to income ratio is for qualifying, right? Using gross income. But you also want to do it using your net income, because you don't pay your bills off your gross, you pay your bills off your net. So if that net income was, let's just say $3,000 again for easy math. So your debt payment's $1,000 divided by that $3,000. Well, now your debt to income ratio would be 33% based off your net. You want to make sure that you really and truly know how much of your expenses are being covered by your net income, right? That's important for you, for your own financial system of success, that efficient and effective budget, right? And so, I always say that there's nothing cookie cutter about your financial plan. Everybody's financial plan is going to be different, right? And so when you talk about what lenders like to see, they typically refer a debt to income ratio below 30%. Below 36%, with anything above 43% making loan approval challenging. I'm going to say, this is me, right? That the ideal is not to carry a lot of debt, only what you must, right? So when you think about carrying debt, auto payments, right? Car payment, because if you bought a brand new car, most people can't go buy a brand new car with cash, right? So auto payments, house payments, right? You may have, it's like all of this other debt you need to really look at before you start to accumulate it. You may have student loan debt, but car payment and auto payment, right? We have 1.8, $1.9 trillion collectively in credit card debt across the nation. You don't want to carry a lot of credit card debt, is what I call, in most instances, unnecessary debt. I know with everything going on economically around the world today, people who are carrying more credit card debt because they're using their credit cards to supplement the income because the cost of everything is so high, right? But keeping credit card debt, using credit cards effectively down to a minimum is where you really want to be. So when you start to look and analyze your debt, what's really necessary debt and what debt is just costing you extra. So then you look at how to reduce your DTI, or your debt to income ratio. And you want to focus on credit cards or personal loans to lower your debt burden, right? So I say look at credit cards first, because if you pay those off, you can then start to use them effectively, right? And there's a office hours about using credit cards effectively. So you want to then start to use them effectively. And when you think about some of the things that you put onto credit cards, you don't want to just continue to pay interest on those things. So you bought this $100 sweater, and now you're continuing to pay this 25% interest on it. $100 sweater has now become, $150 to $250 sweater, right? So start with your credit cards, right? The other, for some, when you wind up becoming really, really intentional, you say, I want to pay off this debt. Once credit cards are zero, you may go back and say, I want to, start paying off a car loan, right? Or making extra payments to a mortgage loan. Okay. And for some, I had clients who just had to say, they already had a second loan, a job. I'm not a fan of a second job. I am a fan of additional revenue streams, but not necessarily a job where you're going from one job to another job. Now, because I'm not a fan of it, doesn't mean that for some it's not supposed to happen. But where's the additional revenue? So when you start to talk about how to increase your debt to income ratio, increase your income, right? So that you can, or negotiate a raise with your current job. So what are you going to do with that additional revenue? You're going to pay off some debt, right? Have a plan, though. The plan is not to keep the second job. The plan might be to keep additional revenue, but a second job, especially if you have young children, and those children are at home, and because you now have this second job, you have to, those children are with someone else. So just look through that. But whatever it is, if it's an additional job, or now you've gotten and negotiated a raise at your current job, be sure to use that money for your debt strategy. And some of the benefits of having a lower debt to income ratio or a lower DTI is it improves your chances of loan approvals and better interest rates if you're trying to get a loan. It also frees up more income for savings and investment. So when you were paying, $100 a month on these credit cards, now you can reallocate those funds to $100 in your savings or investment or buying precious metals, right? It also is going to reduce some stress and worry, because a lot of people are worried about the debt that they have, right? And then it's also going to set you up for later in life. So everything is better when you start early, from savings to getting life insurance to getting some long-term care insurance to starting your retirement plan, right? And so the earlier you start, the better. Remember, when it gets to the point where you want to retire, or you don't want to retire with all of this debt, So when you start to reduce this debt now, okay, well, I'm not going to carry any credit card debt, you know what I mean, into retirement. Because again, now I got more money. I can reallocate that towards my retirement savings. So you want to just systematically start to lower debt. Do I necessarily want a new, a big old car loan when I want to retire? No, because you don't want all of your money being eaten up by debt, especially if you will then in retirement be earning less than you would when you were working 40 hours a week, right? So it does set you up for later in life. Keeping your debt to income ratio in check can increase your financial health. It just absolutely does. You have better opportunities, and it sets you up for the future. Debt is not the thing that you want hanging over your head, right? So do me a favor. Think about all of your current debt. And when you think about it, what do you feel in your body? Do you start feeling stress and worry? Do you have knots in your stomach? How much of that debt is for things? So not a car, not a home, but for clothes, shoes, and electronics, and they're sitting on credit cards. What are your debt payments keeping you from doing, right? If you didn't have $300-400 in payments in credit cards or just other stuff, what would you do if you didn't have those debt payments? Where would you reallocate those funds? So when we talk again about that 2053 prediction of Blacks having zero wealth, getting your financial house in order is a way that we ensure that prediction doesn't become a reality. What is your plan? And in decreasing that debt load, do you recognize how that also helps to keep that prediction from becoming a reality? Right? Again, we talk about breaking the generational curses. If they stop with you, the new systems of success must start with you. You got to get the tools, set them in place to be able to pass them down to your generations and to your children and the generations that follow. Right? What are those systems of success? Are you learning them? Are you creating them? And are you passing them down? Right? So what's my favorite thing for today? That's simple. Debt strategy. Right? Taking a look at it, figuring out where you are, and making a plan for it. And I'm going to talk more about the plan for debt strategy tomorrow. But what are you going to do today? It's real simple. Pull out your credit reports. Let's just get prepared. Pull out those credit reports. How much debt do you have? Auto, home, credit cards, student loans, other installment loans, lease payments when we're going out and we're renting, TVs and furniture. How much debt do you have? And sit with that. When you start to add it up and you look at all of the debt in this one place, and you're looking at all of these payments, what does that make you feel? Pay attention to that. And then we want to create a plan to decrease the credit card debt first, and then go to others. And again, I'll talk about that plan tomorrow. Okay. So if this information has been helpful to you, please make sure you subscribe to the channel, turn notifications on so that you don't miss a training. And as I do always, I'm going to ask you to share the information. Don't be the gatekeeper to this information. You never know what somebody else is looking for, in need of, and praying about, or worrying about. So don't be the gatekeeper. Share the information with somebody else. Be a blessing. And then also, always remember to give yourself some grace. What you didn't know yesterday, what you didn't do yesterday, what you messed up on yesterday, that's in the past. However, tomorrow you can't continue to give yourself grace for the things that you learned today and don't do. All right. So give yourself some grace. Keep striving for your next level of excellence. Never, ever, ever give up on you, and always invest in you. I promise you, it is the best investment that you will ever make, and you will never, ever, ever regret it. Thank you so much for joining me today. I am Crystal Gunn, and I'll see you next time. Thank you for watching. I appreciate your time. Be sure to join me for the private online Q&A immediately following. The link is in the description. And if you haven't done so already, please be sure to subscribe to my channel and turn notifications on so you never miss this opportunity.